Silver price collapsed at the coin show. Dealers said this happened. It was supposed to be an ordinary morning. Buyers lined up, dealers stocked their cases. The mood was steady, even optimistic. Then, within minutes of the market opening, the number on every screen began to fall. $2 gone, then more. Behind the tables, something shifted. Quietly but unmistakably. Not panic, not yet. But the kind of silence that experienced dealers know not to ignore. Because what happened next on that show floor was not really about silver at all. It was a signal. And by the end of this story, you will understand exactly what it means for anyone holding wealth in this economy. Welcome back to Precious Metals Intelligence, the channel dedicated to helping serious, wealth-conscious viewers understand what is actually happening beneath the surface of today's markets. If you value clear, disciplined analysis over noise, you are in the right place. Before we continue, we'd love to know where you're watching from today. Drop your city or country in the comments below. It always means a great deal to see how far this community reaches. It began like any other morning at the coin show. Dealers arrived early, set up their tables, and prepared for another day of buying and selling. Buyers walked in with familiar routines, checking prices, greeting dealers they had known for years. Nothing about the morning suggested anything unusual was about to happen. Then the market opened, and within minutes, silver began to fall. It was not a small move. The price dropped by nearly $2 almost immediately. For anyone watching the screen, it looked sudden and sharp. For dealers who had spent years reading these markets, it felt familiar but still worth noticing. One dealer later admitted something surprising. He said he had not even realized the price had dropped until someone pointed it out to him. He had been too busy helping customers, making deals, and moving inventory to check the numbers. This detail matters. It shows something important about how physical markets actually work. The people buying and selling real metal are often more focused on the transaction in front of them than on the number flashing on a screen somewhere else. This is the first clue in a larger story. While the spot price is what most people see and react to, it does not always reflect what is happening on the ground. A price can fall on a screen while real demand stays steady or even increases. This gap between the reported price and the real behavior of buyers and sellers is something serious investors learn to pay attention to. Another dealer described the day differently. He explained that the previous day had brought optimism, prices had climbed, and buyers felt encouraged. Then, almost overnight, that gain disappeared. He said this kind of swing was not shocking to him. He had seen it before, especially during the summer months when trading tends to slow down and prices become more unpredictable. This raises an important question. If experienced dealers expect these swings, why do so many everyday buyers react with fear or hesitation when they happen? The answer lies in the difference between short-term price movement and long-term value. A person who only watches daily numbers may feel uneasy when the market dips. But a person who understands the bigger picture often sees the same dip as an opportunity, not a warning sign. At the same event, one dealer shared something else worth noting. He said he had expected to see more silver coming into his shop that day. Instead, he saw a surprising volume of gold. This shift, even if small, hints at a change in how people are thinking about their money. When more sellers bring in gold rather than silver, it may suggest a shift in confidence, a change in what people believe will hold value best in the months ahead. None of these details on their own seem dramatic. A dealer who barely noticed a price drop, a wave of optimism that faded overnight, a slight shift from silver to gold, but together they form a pattern. And patterns, more than single events, are what serious observers of the economy learn to watch closely. This is the real story hiding behind a single day at a coin show. It is not simply about a number falling on a chart. It is about how real people, real dealers, and real buyers respond when uncertainty enters the room. Some pull back, some stay calm, some quietly begin shifting their strategy without saying a word. For anyone trying to understand where the economy may be heading, these small human moments often reveal more than headlines or official reports. A crowded show floor that slows down by the afternoon, a dealer replacing inventory just as fast as it sells, a shift in what people choose to buy when prices move. By the end of the day, the mood at the show had changed. It was quieter, calmer, but not without tension. The excitement of the morning had faded into something more thoughtful. Buyers were still there, but they moved differently. Dealers were still selling, but they watched the numbers more closely than before. This shift, subtle as it may seem, sets the stage for a deeper question. If physical demand can remain steady even when prices fall, what does that say about where real value is placed today? And if seasoned dealers treat these drops as routine, should everyday investors be doing the same? Behind every coin show table sits a story most buyers never think to ask about. It is the story of the dealer, the person standing between raw metal and the customer walking through the door. To understand why silver's drop mattered so little to some of them, one must first understand how these dealers actually think and operate. Most people assume dealers watch the spot price the way traders watch a stock ticker. reacting instantly to every shift. The truth is more complicated. Many dealers describe their business in terms of movement, not moments. They talk about buying low, selling fair, and keeping metal flowing through their hands as quickly as possible. One dealer explained his philosophy using an old saying: "It is better to make a small profit from someone 10 times than a larger profit from them only once." This single idea explains a great deal about how physical precious metals businesses survive, even when prices swing sharply from one day to the next. This philosophy changes how a person views a price drop. For someone who profits from a single big trade, a falling price feels like a loss. But for someone who profits from repeated smaller trades, a falling price is simply part of the rhythm. The real concern is not whether the price goes up or down. The real concern is whether metal keeps moving, whether customers keep coming back, and whether trust keeps being built one transaction at a time. Another dealer offered a similar view, though from a different angle. He explained that his margins were thin, sometimes barely a few dollars per item, but volume made the difference. A small profit on many items, repeated often enough, created a stable business. This is a lesson that applies far beyond coin shows. It is the same principle that supports countless successful businesses across every industry. Profit is not only about the size of a single deal, it is about consistency, trust, and the ability to keep moving forward even when conditions change. This is where the concept of velocity becomes important. Velocity, in this context, means how quickly metal comes in and goes back out. A dealer with high velocity is not sitting on a stockpile, hoping prices rise before selling. He is constantly refreshing his inventory, buying today, selling tomorrow, and repeating the process again and again. This approach reduces risk. It means a dealer is less exposed to sudden price swings because he is not holding large amounts of metal for long periods of time. One dealer admitted something honest and revealing. He said he had priced some of his premium silver higher than what it was currently worth, based on what he had originally paid for it. When asked if this would cause a problem, he laughed and said it did not matter. He explained that he would simply replace the inventory at a lower cost later and make up the difference in future sales. This kind of thinking reflects confidence, not carelessness. It shows a business built on long-term movement rather than short-term panic. This mindset stands in sharp contrast to how many casual investors react to price changes. When the average person sees a price fall, the instinct is often to feel regret or fear, especially if they recently made a purchase. But professionals who work with these metals daily see the picture differently. They understand that price is only one part of the equation. Demand, trust, timing, and consistency matter just as much, sometimes even more. There is also an important lesson here about patience. Several dealers mentioned that summer months tend to bring slower activity, something they refer to as a seasonal lull. Rather than reacting with alarm, they simply adjust their expectations and continue running their businesses as usual. This kind of steady, unemotional approach is often what separates long-term success from short-term panic in any market, not just precious metals. By observing how these dealers think, a clearer picture begins to form. A falling price is not automatically a crisis. It can be a normal part of a larger ongoing cycle. What matters most is not the number on the screen, but the decisions made around it. Dealers who understand this tend to remain calm, adaptable, and focused on the long game, regardless of what a single day's price movement suggests. This raises a deeper question for anyone watching from the outside. If professionals treat these price swings as routine, why do so many everyday buyers still feel uncertain? The answer may lie not in the market itself, but in the mindset brought into it. And that mindset is exactly what the next part of the story will explore. While dealers focused on movement and margins, another group at the coin show carried a very different weight on their shoulders. These were the buyers, the individuals walking from table to table, deciding whether today was the day to spend their money on silver or gold. Watching them closely reveals something dealers rarely discuss openly: the emotional side of investing in precious metals. Not every buyer reacts the same way to a falling price. Some pull back immediately, worried they might be making a mistake. Others see the same drop and feel something entirely different, a sense of opportunity rather than fear. This difference in reaction often has little to do with knowledge of the market and everything to do with experience and mindset. One dealer offered a simple but telling observation. He said that most people want the best possible value for their money, especially on a day when prices are falling. This instinct makes sense on the surface, yet it also reveals a common mistake. Many buyers focus so heavily on the exact price at the moment of purchase that they lose sight of the larger reason they are buying in the first place. For many serious stackers, the goal was never to catch the lowest possible price on a single day. The goal was protection against inflation, protection against a currency that slowly loses its purchasing power over time. One dealer described his own beginning in this world plainly. He said he first bought a single ounce almost by accident, after stopping by a coin show out of curiosity. It was only later, after research, that he understood the deeper reason people choose to hold silver and gold. He described it simply as protecting what one has already worked hard to earn. This idea, protecting value rather than chasing profit, is central to understanding why seasoned buyers do not panic when prices dip. If the purpose of holding metal is long-term protection, then short-term price swings become far less important. A drop of a few dollars in a single morning does not change the underlying reason someone chose to hold real, physical wealth in the first place. History offers a powerful lesson here, one that reaches back further than most buyers realize. There was a time when paper currency was directly backed by gold and silver. A person holding a note could walk into a bank and exchange it for real coins. It was not a promise. It was a guarantee written into the very fabric of the monetary system. Old currency notes discussed at the coin show told this story clearly. Some notes could be exchanged for actual gold coins. Others could be exchanged for silver dollars. At the time, this felt secure. The paper was simply a stand-in for something real sitting safely in a vault. But history reveals what happened next. At a certain point, that guarantee was taken away. People holding notes could no longer exchange them for the metal they represented. The paper remained, but the promise behind it disappeared. Anyone who had trusted the paper alone, rather than the physical asset, was left holding something far less valuable than they once believed. This historical shift is not just a story from the past. It carries a warning that remains relevant today. When wealth exists only as a promise, whether in paper form or in digital form, it depends entirely on someone else keeping their word. Physical gold and silver do not carry that same risk. They do not depend on a bank, a company, or a government fulfilling a promise. What a person holds in their hand is simply theirs. This is why many experienced buyers describe precious metals as protection against something they call counterparty risk. It means the risk that comes from depending on another party to deliver what was promised. A dealer at the show pointed out something sobering. Even in recent times, companies have issued promises to deliver metal that they were later unable to fulfill. Those holding paper claims were left with far less security than they believed they had. Understanding this history changes how a falling price should be viewed. A short-term dip in the market does not erase the deeper purpose behind owning something physical, something that cannot simply disappear because a promise was broken. This is the mindset that separates panic from patience and fear from confidence. By the end of the day, it became clear that the buyers who stayed calm were not simply lucky or emotionless. They understood something the market itself could not shake. Real value does not vanish because a number on a screen moves lower for a few hours. That understanding shapes not only how a person buys silver and gold, but how they view money and security in a much wider sense. This leads to the next part of the story, one that looks beyond the coin show itself and asks a larger question. What does a single day in a single room reveal about the wider direction of the economy? A single coin show, on its own, might seem like a small and unimportant event, a handful of dealers, a steady stream of buyers, a price that rose one day and fell the next. Yet when examined carefully, this small setting offers something far more valuable than a simple record of transactions. It offers a quiet window into the wider economy, one that often moves before official reports or headlines ever catch up. Consider the timing of the event itself. Several dealers mentioned that summer months typically bring a slower pace to their business. They referred to this as an expected seasonal lull, not a cause for concern. This kind of pattern recognition is important. It shows that experienced participants in this market do not react to every fluctuation as if it were a crisis. Instead, they understand rhythms that repeat year after year, and they plan accordingly. This same principle applies far beyond precious metals. Businesses, industries, and entire economies move through cycles. Recognizing a normal cycle, rather than mistaking it for a sudden collapse, is often what separates calm, strategic thinking from unnecessary panic. Yet within this expected slowdown, something more specific stood out. More than one dealer noted that gold was moving faster than silver that day, a pattern they had not necessarily expected. One dealer admitted he had anticipated seeing more scrap silver and older coinage coming through his doors, but instead found himself handling more bullion gold than usual. This small shift may seem minor at first glance, but it raises an important question. When sellers begin favoring one form of wealth over another, even slightly, it can reflect a quiet change in how people are thinking about safety and value. This is the kind of detail that rarely appears in large economic reports, yet it often reflects real sentiment more accurately than a headline number. A shift toward gold, even a small one, can suggest that certain buyers and sellers are seeking a form of wealth they view as more stable during uncertain times. It does not require a dramatic announcement or a formal shift in policy. It happens quietly, one transaction at a time, on the floor of a coin show that most people will never hear about. There was also the matter of newly released government coins, which drew significant attention and quick resale activity. Some buyers purchased these coins directly, only to sell them almost immediately to dealers for a modest profit. This detail, small as it may seem, reveals something about how people behave when they sense an opportunity, even a limited one. It reflects a broader truth about human behavior in uncertain economic periods. People remain alert. They watch for small openings, react quickly, and adjust their strategy without waiting for permission or confirmation from a larger authority. Taken together, these details form a pattern that is easy to miss if one only looks at the price of silver on a single morning. A seasonal slowdown, expected and accepted without alarm. A shift toward gold, subtle but noticeable. A quick, opportunistic response to a limited product release. None of these signals shout for attention, yet together they whisper something important about where confidence is shifting and how ordinary people are quietly adjusting their financial decisions. This is often how meaningful economic change begins, not with a dramatic announcement, but with small, human decisions made in ordinary places. A dealer refilling his case a little differently than before. A buyer choosing gold instead of silver without fully explaining why. A show floor that feels calm on the surface, yet carries an undertone of quiet recalculation beneath it. For those willing to pay attention, these moments offer something valuable. They offer an early, honest glimpse into how real people are responding to real conditions, long before those responses ever appear in official statistics or economic summaries. It is in these overlooked details, not in the loud headlines, that the truest signals of change are often found.